The cryptocurrency world held its breath. All eyes were on Ripple, XRP. Then it happened. The U.S. Securities and Exchange Commission made its move. Multiple XRP futures ETFs were approved. The market erupted. XRP, once entangled in regulatory battles, was finally unleashed. The impact was immediate. XRP's price soared, reflecting a surge in investor confidence. The approval was a watershed moment. It signified a shift in the regulatory landscape. Finally, institutional investors had a regulated avenue to access XRP's potential. This wasn't just about price movement, it was about validation. The SEC's decision signaled a newfound legitimacy for XRP. It opened the door for wider adoption. The future suddenly seemed brighter for Ripple and its ambitious vision. The stage was set. A new chapter was beginning for XRP, a chapter filled with both immense promise and lingering uncertainty. The game had truly changed. The surge in XRP's price wasn't driven by speculation alone. Large holders, the whales of the crypto ocean, were making their move. They were accumulating XRP, their massive holdings a testament to their confidence in its long-term potential. Technical analysts watched with keen eyes. Charts lit up with bullish signals. XRP had broken out of a long-term descending wedge pattern. This was no ordinary breakout. It hinted at a potential surge, a rally that could propel XRP to new heights. The 50-day exponential moving average became a line in the sand. XRP held firm above it, reinforcing the bullish sentiment. Momentum was building. The market was waking up to the possibility of a sustained upward trend. Excitement rippled through the crypto community. Could this be the beginning of XRP's long-awaited bull run? The signs were there, but the market knew better than to celebrate prematurely. Challenges remained, and the crypto world braced itself for the ride. The approval of XRP futures ETFs triggered a race among financial giants. Each sought to capitalize on the burgeoning demand for XRP exposure. ProShares, the pioneer of Bitcoin futures ETFs, was quick to seize the opportunity. Their offerings, including the ProShares Ultra Short XRP ETF and ProShares Ultra XRP ETF, provided investors with leveraged and inverse options. These tools allowed for sophisticated trading strategies, attracting both bullish and bearish participants. Teucrium, another major player, entered the arena with their 2x XRP ETF. The product's debut was met with significant interest, racking up impressive trading volume on its first day. The competition was heating up. Meanwhile, all eyes were on Grayscale, the crypto asset management behemoth. Their application for a spot XRP ETF was pending with the SEC, the deadline for a decision looming large. An approval could be a game-changer, potentially dwarfing the impact of the futures ETFs. The battle for XRP ETF dominance had begun. Each player brought their own strengths and strategies to the table. The competition, while fierce, would ultimately benefit investors, providing them with greater choice and flexibility. Analysts huddled, their eyes glued to charts and data feeds. Whispers of price predictions filled the air, each more optimistic than the last. Some, emboldened by the recent surge, projected XRP reaching $3.63 in the short term. Others, more bullish, dared to dream of $5, especially if Grayscale's spot ETF application received the green light. The long-term outlook was even more tantalizing. Predictions ranged from $27 by 2026 to a staggering $77 to $100 by 2030. Some argued that XRP's utility in cross-border payments, its raison d'etre, justified a price far exceeding $100. But amidst the euphoria, a note of caution lingered. The crypto market was known for its volatility, its unpredictable swings capable of wiping out fortunes overnight. The road ahead was unlikely to be smooth. Still, the potential was undeniable. If Ripple continued to execute its vision, if regulatory clarity improved, and if institutional adoption gained further traction, then XRP's future could be very bright indeed.